On behalf of the Kitchi Gammi Club and Club Entrepreneur, welcome to our workshop on mergers and acquisitions. Today we're going to be focusing on the M&A market, covering topics such as who are buyers and sellers of small companies, how companies are valued, mistakes sellers make, and much, much more to help companies with all facets of the sale process and buying process. I introduce a panel of experts who can serve you as trusted advisors today for Rick and Chip down there. Thanks for coming up from the cities. And however, before we get started for today, I'd like to thank our three sponsors who helped make this a possibility: the Duluth Experience, Duluth Screen Printing Company, and Pure Clean. And then to stay connected with us, you can visit the Clubby website. We have a growing Facebook group that's actually got quite a bit of traction. We have a closed LinkedIn group that you can find us, Club Entrepreneur Duluth. A lot of good topics in there, and then also on the email list to stay updated. This will be our last Clubby we're taking June and July off, and then we'll ramp things back up in August with an entrepreneur barbecue. And if you're interested in learning a little bit more about membership at the Kitchi Gammi Club, feel free to reach out to me and I can connect you with Paul. As I mentioned, the future Clubby date, August 16th, which is the third Tuesday of August. We're going to have a barbecue out on the porch and just kind of get things set up for the fall and see where that takes us. So now I'll introduce today's panelists: Chip Myers, the founder of Franklin Partners, and Rick Brimacombe of Brimacombe & Associates. I'll have them introduce themselves, a quick little bio and a little bit of story. We'll keep it brief, and I'll have them speak about 1 minute to 3 minutes apiece here. So each panelist will share their background, so the audience here can get an understanding of who you are and what you guys do.
Go ahead. Go ahead. All right. So I guess I get to go first. Hi, my name is Rick Brimacombe. I'm actually the founder of Club Entrepreneur, which I got going in Minneapolis in 2007. Craig got his group going last November. I have other chapters in St. Paul, Fargo, and Hudson, and looking at a couple of other markets in the 5-state area. Pleasure to be here. Thanks for taking the time to fit it into your schedule, and thanks, Craig, for having Chip and I up. Earlier in my career, when I first got going, I was writing investment research, so I kind of learned how to analyze companies. Then I went into investment banking and worked on selling companies and raising capital and doing venture capital deals. And then I was hired away to go to work at one of my clients, a venture capital firm that was at the time Norwest Venture Capital. They have since split into two groups. Norwest Equity Partners does private equity there in Minneapolis. Norwest Venture Partners does venture capital there in Silicon Valley now. And then I started a venture fund with a couple of other guys called Sherpa Partners, and have now been doing venture capital deals for about 20 years or so. As far as the topic today, I actually, kind of thinking about it driving up, actually come at this discussion from three different directions. First one is, while my investment banking experience is significantly less than Chip's, I did spend part of my career on the investment banking side. I also have co-founded a couple of companies that went through the M&A process. So from a kind of owner-operator, I've sat on that side of the table. And then also as an investor from the venture side, I've had that experience. So been able to see this topic, the merger and acquisition world, from many different directions. What I do now for most of my time is run my own practice, Brimacombe & Associates. I help companies grow, do that in a variety of ways. Usually revolves around assembling resources, refining strategies, and securing funding. So I'm kind of a right-hand guy to executive teams as they grow their businesses. And Chip and I have interacted on a number of different fronts. I've had the pleasure to work with Chip. He's very good at what he does, and that's why I invited him to join us today. So I'm kind of the color commentary, and Chip is the main course. So with that, Chip Myers.
Well, thank you. It's hard to believe I'd be anybody's main course, but I'm here with my colleague Joel Fisher, and our firm is Franklin Partners, and we're advisors, primarily sell-side advisors to private companies, sale transactions or change of control transactions. And I started the firm in the mid-1990s, and before that I had been purchasing and turning around companies, middle market companies, and before that I'd worked in the corporate environment and corporate development. And when I was a younger man, I decided I grew up in an entrepreneurial environment, and when I got out of business school I worked for big corporations, New York Stock Exchange companies, and decided it wasn't as much fun as working with entrepreneurs. And our practice now is primarily working with entrepreneurs. From time to time we do corporate carve-outs, so we work for private equity firms, but our real specialty is entrepreneurs. We're 5 people. We have kind of a diverse background. We're all partners. We own our own firm, and we kind of sing for our supper every day, I like to say. We've worked in a variety of industries. Kind of our basic approach is that every opportunity is unique, and if presented right, is an opportunity for somebody to make a pretty interesting investment. So we bring a different perspective to selling a company than somebody who maybe built it brought. 2 of my partners have spent most of their career in investment banking, one of them working with Rick some time ago. Joel came out of commercial banking, and as I said, I came out of industry. So we think of ourselves as having sat on all sides of the deal table and can appreciate what needs to be accomplished from everybody's point of view who's at the deal table. It's a complicated process selling a company. For those of you who have done it, and maybe let me ask you a few questions when I finish this. But for those of you who have done it, you know that it's kind of a unique process unto itself. I mean, it's a complicated long-term selling process, and for firms like us, we've tried to put it into a structure so that we can create competition and create leverage, negotiating leverage, and create alternatives for our clients. And we can talk about that more if you want to. But I did want to get a sense of what all your interests were. I know that there's a couple of big-time bankers in the room, but other than that, how many of you are actually own or manage companies, businesses? So the majority of people here. Okay. All right, well, do you have some questions, or how would you like to?
I can, we'll have open audience participation, so as I have a list of questions here to kind of structure the conversation, but please feel free to raise your hand. I mean, all of us are at a different spot, and I mean, we might have a question that you want to ask a little bit deeper on. Feel free to raise your hand, ask any of our guests up there, and kind of allow that to be a thing. We don't need to just wait for Q&A at the end. So I can just start with what I have going through here. So we can just have about a minute response, sure, about in between each of them. So in anticipation of selling a business, what advice planning should a seller consider, first on a personal level, and second to prepare the business for sale?
Let me go first since you're eating a little
sure.
bit.
Go ahead.
So it was 2 parts, on a personal level and then second from a business perspective?
Correct.
All right, so I guess for myself, from a personal standpoint, I think you really need to evaluate your motivation for selling the business. Why now? Why not later? Where are you from a life stage perspective? Are you really wanting to kind of get off the treadmill? Or if you sold the business, would you be kind of a little bit lost? And so I guess probably from a personal perspective, is it the right time? And what might you do afterwards? I guess I've seen a lot of folks sell their companies and play golf for one summer and 3 or 4 months later be kind of bored and not sure what they're going to do with themselves. So I think just from a personal motivation and standpoint, really kind of understand why and why now and why not a year from now or 5 years from now or 10 years from now. Obviously there's market forces, and maybe we'll get to that later, that might push that decision up. But from a personal level, well, how do you want to spend your time afterwards? From a company perspective, and I'm sure Chip will talk about this, I don't think you want to try to sell the company without putting effort into preparing to sell the company. So for instance, if you were going to sell your house, I don't think you'd throw a for sale sign in the yard the weekend before you wanted to try to sell it. I think this is a multi-year process, and one that you're going to want to do things on a business perspective to make your business as sellable as possible. There are going to be things you're going to want to do to clean it up and make it look better. There are things you're probably going to want to do from a financial perspective to help things out. You're going to want to assemble a team like Chip and others to make sure that you're doing the best you can. So I think from a business perspective, I guess the thing to wrap it all up would be give yourself enough time to go out and prepare yourself as best as you can for the sale.
I might add to that from a business perspective. There are meaningful things that you want to do from a tax perspective, tax planning perspective, that will save you a lot of money. And this is, most people who sell their businesses are seeking to maximize value, and you should be thinking of value as after tax cash that you have left. And there are definitely things that you could do both with the structure of the business and personally that you should be thinking about and doing as much as a year in advance, and in some cases 5 years in advance. And there are very few, my experience is very few people take the time to do that. And I don't know if that's because the people they've relied on for tax advice in the past they've had a fairly transactional orientation towards just simply doing a tax return as opposed to looking towards the end. But this is very much a game where you have to understand what your end game is and work backward. And I would start with my tax guy. And if I didn't feel that this is so important that if I were you and I wasn't sure that he had that skill set, I would seek out somebody who did. And most of the law firms have tax specialists in this area, but many of the accounting firms do not. And are there any accountants, any CPA firms right in the room? I think you know what I mean. And they'll say, well, it should be a stock rather than an asset sale. But there's more to it than that, as you know. And there's a form of the corporation, and there are look-back periods, and there are depending upon the kind of money you're getting and your goals in life and your age, there are trusts and things that should be set up to at least defer taxes, and it's not a small thing. I guess the second thing I'd say is you want to sell a business when the wind is at your back, because they're not buying you for what you did 5 years ago or for your personality. They're buying you for what they can do with this thing in the future. And for them, it's very much an investment decision, so it's about future cash flows. And so you want to do it when the outlook for your business is good, when you're at a good stepping off point in terms of maybe you're the largest guy in the Midwest and it fits in a broader national strategy that you don't have the energy to do, but there's an investment thesis there. And so what I'm saying is you don't do it when things are sort of sideways or things are upside down, because it's, as you probably know, trying to buy something that's hard to understand is time consuming and really hard to come up with a value. In our business, we call it trying to catch a falling knife, which I think is from Greek. It's either from the Bible or Greek mythology. I don't know. And
Doesn't work well.
it doesn't. So you want to do it when the wind's at your back. You want to have planned for it. You want information is really important. So you think about it. So somebody evaluating this needs information. Unlike the public markets, this is where information is shared and people are bidding and digging up information. So a general understanding of the business is established. In a private company, that's not there. So you have to, you're either going to go through a painful process with somebody like us finding that information, or you've got to start doing it yourself in preparation for that. You know, frankly, you want, although add backs are always something, you know, adding back expenses to earnings to stay what they might be with someone else, under someone else's ownership is important. Too many add backs are kind of hard to sell. So if you're accustomed to taking a lot of money out of the business and funny things, you should be thinking about simplifying that and maybe taking it as dividends or as income or something. But it's an arduous campaign. It probably takes more than you think, and so you've got to be committed and you've got to plan for it.
Thank you. So when is the right time to sell a business, if there is a right time?
Well, I think, like I said, when the wind is at your back, and you know, uncertainty is what drives down valuations of businesses. So when the wind is at your back, ideally when the economy is strong, although I will tell you, when I think that Todd and others who are in the financial services business would tell you that there's so much money in the markets these days that valuations tend to hold up when for good opportunities when the economy's down. But you know, generally the best time to sell is when the wind is at your back, quite simply.
And adding to that, just slightly different words, would be that there's 2 meters in a given industry. There's like the reality meter, and then there's the hype meter. And when the hype meter is off to one side and the reality meter maybe hasn't caught up because the hype is just happening, or the story, like Chip said, maybe you're the leader in the upper Midwest in a category that's growing, the economy's good, so kind of the hype meter's up. For companies that I work with, which are a little bit more growth-centric, usually reality trails the hype. And so there's kind of trying to maximize value on what is the outlook for the category and how strong is that hype meter going, and you want to be high enough on the growth curve that you can capture that story, but not kind of wait for reality in the market category to maybe to level off and go into a slower growth phase. So if you're kind of looking at an inflection point in the growth category, it would be kind of heading north as opposed to, oh, everything's going to kind of start to slow down.
What is meant by the sales process, and why do owners assemble outside advisors to assist and manage a sale process?
Well, we tell people it's a 6 to 12 month process to sell a business. And so it's quite a long and arduous campaign that requires fundamental marketing of the investment opportunity to the right kind of buyers, that requires due diligence on the side of the buyers, which typically takes 90 days, and more legal documents than you can imagine. And you have to think that Joel and I were looking at this the other day, there were 4,000 companies sold in the United States last year. So to begin with, when you go to sell your company, you're competing with 3,999 other opportunities that are floating around the market. So it's got to be, your business has got to be attractive enough, and it's got to be presented to the right people in an attractive way. There's a skill to that. There's the buyers who look at businesses, and believe me, there's more than 4,000 buyers of these businesses, all have, you have to presume that they all have the A team. And although this may start out as a collaborative sort of venture with these guys, in the end, it is a competitive process. And anything less than a number that they can pay for their business is more profit for them. So if you're going to be sitting across the table from the A team, and they're going to have the A team, you'd be well advised to have the A team. So that means accounting people, tax people primarily, legal people, and investment advisors. And it's the process itself. Would you like me to kind of walk through what's involved in the sale process? So it typically starts with, the way we do it, it starts with an in-depth analysis of the business from all perspectives. And we're looking for an investment thesis, and we're looking for things wrong. Now, we need an investment thesis because we're presenting this to people, and they've got to see a string here that leads to a number that you don't tell them, I want $30 million for the business. You paint a picture that leads one to believe that there's a variety of outcomes here depending upon what their needs are that could be attractive. So that's creating the investment thesis. And frequently, the investment thesis is not the same strategy that the owner has managed the business on. Because those of you who run a business, like we run a business, you run it primarily for cash flow, right? I mean, that's how you keep things going. And then you have a strategy that you're following, but if the strategy isn't working, you still got to have the cash flow because you got to pay the rent. And then sometimes if you're clever enough, you had a good strategy at the beginning, but maybe you changed it a couple times. And certainly in retrospect, if you're successful, you had a good strategy, right? So that may not be the same as what's attractive to an investor. And so somebody like us will shake down the business from its external opportunities and strengths and weaknesses, and internally, and come up with some alternative approaches to presenting it that the client will review and discuss and make the final decision about. And we're also looking for issues because we want to anticipate issues so we know when to present them and present them in the most constructive light. And perhaps I could give you an example. We sold a manufacturing company, I guess last year, that manufactured a consumable part that was used in the manufacture of aluminum cans.
Yeah.
And
So any or two-piece can like this.
And they were one of two people in the world who made it. It was a proprietary part. The can industry, as you might imagine, the can making industry is consolidated to a handful of companies around the world. As a result, the can making equipment industry has consolidated. The can making equipment manufacturer makes this part, but it isn't as good as the patented part by our client. And so he has 80% of the market and 80% customer concentration. So if we called people and said, we've got a very interesting, and he had a 40% pre-tax margins, making a machined steel product. No real brand, so and sold to can makers. So it's just known as made by these guys. And but the customer concentration thing was an issue. And if we called people buyers, private equity firms and industrial companies, we've got a really profitable, interesting company with one customer that makes up 80% of the sales, most people would have said no thanks, because that's risk, and risk discounts the purchase price. They lose that customer. There isn't any amount of money they could have paid for that company that would make up for losing that 80% customer. So we had to tell a story about can making and how it's consolidated and how this is a key part, and how, because the industry is consolidated, by the time we got around to saying who our customer was, one would expect that it would be consolidated. Think of the medical device industry. There's 3 or 4 big medical device manufacturers in the world. So if you don't have customer concentration, if you're a supplier to the medical device industry, then you're not supplying the top 4 guys. We had to get that idea back in something that someone had never thought about, making cans. And
presented in a positive light.
Yeah. And so that when they read it, they said, well, that makes sense. I mean, that would be the guy. Those would be the customer you'd serve. So those are the kinds of things that we're seeking to find and determine how to present. So we wouldn't present that as an initial piece. We would, we sold them on this whole grand story, and then this is one of the attributes of the business as a result of the opportunity in this industry. The next step of the process is identifying buyers. And I don't know if you've been to our website, but we have a cartoon that we think's clever of a lineup of a bunch of guys that look like they walked out of a Star Wars bar. You know what I mean? You know, all those creatures that are, and we call it the usual suspects because most of our clients come to us and say, well, I know who's going to buy my company. And, you know, we call those guys usual suspects, and most of the time the buyers are not the usual suspects. Why? Because they know, they've talked to you, they know everything about the industry. They probably are able to see what's wrong with you as opposed to see the opportunity. It's sort of like, it's sort of like buying your neighbor's boat. I mean, you watch the guy, you know, not wash it every day and watch his kids smash it on the dock, and so, you know, it's really a hunk of junk. So the next step is choosing buyers, and it's important to have a lot of buyers and a lot of different kinds of buyers because you're trying to create not only some leverage from competition among buyers, but you're trying to create a range of opportunities. Buyers who might have a different price, a different reason for buying it, so a different price, a different structure in the payments, might buy the business in different ways, and might have and will have different post-acquisition operating agendas that may or may not involve you or your management. And we always tell our clients it's worthwhile to do this because things pop up that you never considered. And we wouldn't be able to consider them either. We could tell you a bunch of stories about things that pop up, but every situation is unique, and you don't know how somebody's going to look at it. And so when that's determined, the way we do this is we go to buyers without disclosing the company and providing a little bit of information and asking them to sign a confidentiality agreement, whereupon they get our information package, which lays out the investment thesis. And they learn just enough to whet their appetite and get to an initial valuation. So we'll ask them for an evaluation range and an explanation of how they intend to run the business and what their thoughts are about consideration and how they would finance it. Well, obviously, if you're selling to U.S. Bank, you know, the consideration about how they're going to finance it's not an issue, but if you're selling to a private equity firm, that is a consideration. And then typically what we do is take the most interesting of those results, and I should back up and say we do all this on a schedule. So when we send out the information, we would say that on June 1st, we want your initial indications of interest. And we'll send them a letter that says, here are the things you are expected to address. And in our book, if they aren't willing to address all those things, we don't take them seriously. So we take the most interesting of those. Well, first of all, we review all of them with our client and their tax and legal advisors, and we pick the more interesting ones, not necessarily the highest ones, but the ones that seem to offer the most potential, and invite them in for a meeting where our client and his management present the company in the form of a PowerPoint presentation. It's usually pretty much an all-day meeting. It usually involves a tour of the facility, and they would present more information about the company that would substantiate what was in the initial information package that might be addressed somewhat at how the deal might fit with this buyer, or addresses some specific questions that he had, and would whet their appetite. And we wouldn't, when I say we don't necessarily invite just the highest bidders, because, you know, if we had 10 indications of interest and 3 were over 30 million and the others were under, but one of the ones that was under 30 million we thought should be willing to pay more, we'd say, look, you know, we're inviting people in who had a 3 in front of their valuation. We think you should be there too. If you're open to that and are willing to consider that, we'd like you to come in. So we'll ask them when they come in to explain why they're interested and what they like about the business, because it gives our client an opportunity to sort of think through if he wants to slant what he's doing in a certain way. After we get through that process, then we'll ask for a definitive offer. And so and we'll give them a letter explaining what we expect to see in a definitive offer. And our procedure letter is like a 4-page letter, so you can imagine we're asking for some very specific things. And we give them a date, and they come back. Some do, and some drop out at that point. So they come back with a definitive offer. All the while, they know that we're talking to multiple parties. So they know that, you know, shooting in a low ball won't get them anywhere. And typically, the price goes up anywhere from a third to half between the initial indication of interest and the final offer, because now they know we're for real on the competition, and they've seen this presentation. And the presentation is really good. It's usually about 40 to 60 pages. It's structured in a way that uses a language that they're used to understanding. We coach our clients on how to present it. We tell them what kind of questions to be prepared to answer. We're prepared to step in if there are questions that are hard for our client to answer. We expect to know enough about the business to be able to do that extemporaneously and to do it in a way that's acceptable to our clients. So by the time they leave, they go and they say, wow, that was impressive. And that's where we want them. So 2 weeks later, they make their offer. And the offer is usually, it comes in the form that's called a non-binding indication of interest or letter of intent, which means that it lays out the purchase price and the consideration and a timetable to close and the things they need to close, but it's not binding. And it's not binding because they have to do their diligence in order to do this. So then once that's negotiated, so we will negotiate the terms of that letter with one or more parties to get it to where it's acceptable to our client. And then you enter what's called due diligence. And that's which we dress as confirmatory due diligence. Now that may not be meaningful to you, but it's quite meaningful to an experienced buyer, because we're saying, look, we aren't plowing any new fields here. This is not an opportunity for you to come in and talk about things that were never discussed. This is an opportunity for you to come in and confirm what we told you. And that's, that's a lot different. I don't know how many of you tried to sell a business on your own and had somebody come in and give you a list of 20 pages of things, and they just start turning every rock over, and you're saying, well, that rock, there's nothing under that rock that has any relevance to what we're doing here. This is a very structured thing, because they got a certain amount of time to get it done. If they're going to fall off, it's non-binding on us too. And if they're going to dig around in the wilderness for a while and waste our time, we're going to call the show off and move to number 2. And they got to know that. This is a hardball game. They got to know that. So we go to every meeting where things are reviewed and when the lists are out there to make sure this thing stays on track. Simultaneous with that, the parties draft a purchase agreement. Typically, there's a purchase agreement, an asset or stock purchase agreement, a escrow agreement, employment agreements. Help me out here.
Any transition services agreements.
It's usually half a dozen agreements, and they go back and forth, and the back and forth kind of goes on as long as the principals let it go on. And usually at some point we tell our client, you need to tell your lawyer that we need to get this thing done now. And typically this whole diligence and document drafting is 90 days. And invariably there's an inflection point where there's a discussion about the deal. Because if you think about it from the buyer's point of view, and it depends upon the character of the buyer as to how far he'll take this, they're looking for something to haircut the deal, the purchase price. And so it's got to be managed, and it's got to be, and that information, when they want to do that, that information's got to come from them to us, because we know what to say to them. And you got to keep the deal alive, and they got to understand that we have alternatives, and we handle it any number of ways. But there is always kind of a come to Jesus meeting in the last week or so, and things get miraculously worked out. And so when we say there's a process, that's what we mean. So it's a process that requires expertise in a number of areas, and it requires a certain amount of discipline, and frankly, it requires a certain amount of experience and deal knowledge. Joel and I worked on a deal this winter where there was real estate involved, and the buyer said, well, the roof is 30 years old, and you've got in your projection $500,000 to fix the roof, and we think it takes 2 million.
Yeah.
So that we think the purchase price has to be cut by $1.5 million. And, it's, that would be a simple thing, but that was a complicated thing. But it could be almost anything. It could be that we didn't realize that there were 45 contracts here and we want them all assigned before we close. And we would retort, no, we told you in the memorandum that there's 45 contracts here. And we told you that there are 3 that require consents, and we will get you those 3 consents, but that's all we're going to do. And but there's almost anything you can imagine can happen. But anyway, that's the process. It's a long-winded answer, but
Covered the process.
I want to get these last 5 questions. So, these last 5, just trying to keep it to about a minute. But no, that
Or
what types of transactions and structures should an owner consider?
Well, first of all, I'm not going to be the expert here, and then also just to put out to everybody in the audience that if you had a specific question for us, please raise your hand and we'll get your question in there. I guess the thing that has always stuck with me on a project that I worked on is that folks that we were out raising capital, strategic buyer got wind of the fact that we were out raising money. They approached us and said, hey, would you be open to selling versus raising capital and continuing to grow your business? And we said, well, not really for sale, but if you have a number out there, what might that be? And so there's a little bit of negotiation, and frankly, they far exceeded where we thought they would be. That goes against something else, I would say, is one buyer, no buyer, but that's another story. Anyway, so this particular company put a pretty healthy number out there, and we fit strategically for them and kind of fit into what we talked about a little bit earlier, is it gave a path for a company to continue to move forward with what they're trying to do. Anyway, it ended up having an earnout, and in the earnout, we structured it in a way that the earnout was tied to orders, not sales, because sales didn't come until the install. There was things they could do to drag the install out, and then also sales didn't come until the installs were okayed on the customer side. And so there are a couple of kind of steps in the process that we thought they could play with. So we structured the deal purposefully on the earnout to have it tied to orders, not sales. And so there are little things that you might do with the type of transaction you get to better your situation, and those are probably going to be on a case-by-case basis.
And Chip, you can take the next question. What kinds of mistakes do sellers make?
I would say the biggest mistake, I'd say there's 2. One is they underestimate how rigorous the process is, how much time it takes. And so they try and do it themselves. And I mean, when we work on a deal, there's at least 2 of us working on it full time. So it's very hard for a guy in his management or a woman in his management to run a company and do this. And I'd say the second mistake they made, which gets to something Rick just said, is they engage with one buyer. And it's just,
What did you say?
engage one buyer only.
Kind of on the opposite side here, what kinds of mistakes do buyers make?
Well, coming from the venture capital side, I never see a valuation that I like. So whatever the valuation is that the entrepreneur says is too high from my perspective, the investor's side, right? So that's kind of the same thing as the buyer. Really, the only thing that you can control in the process is the going-in price. Everything else you can try to control, or you can try to structure it in a way to minimize the risk or so forth. But truly, the only thing that you ultimately have full control over is the price. And so I think a mistake is to be too optimistic about what the future holds. Too many things coming together to paint the picture that Chip did such a nice job painting, that this company was going to grow and grow and grow. And so a healthy set of either skepticism or at least kind of a realistic point of view as to what the going in price and then subsequent financial projections against that price would be.
I'd say the biggest mistake I've seen buyers make is to mishandle the people post-acquisition in the acquired company. Yeah. And try and, Joel just said culture, try and impose a culture or a change on it that affects the organization's ability to perform. And many of you have maybe done this yourselves when you purchase things, but it's, you know, a business is a fragile thing, and it's made up of people, and the team is successful for a reason, and if you mess around with it too much, you can destroy the secret sauce, and you can do that really quickly. I've done deals where the key salespeople leave after 6 months because they just couldn't take it.
There's studies out there that show that a lot of deals fail. The number's high. I just can't remember what it is.
Well, fail to hit their intended objectives. It's
Exactly.
like 80%.
Yeah, because integration just isn't thought through, and the culture and environment of the company or its relationships with its customers aren't taken into account to a certain point, and it just erodes post-acquisition.
So as a seller, that's why it's important to have multiple buyers and to consider, have them talk about how they intend to run the thing post-acquisition and to check their references. And I don't, you're not checking a guy's reference, you're checking an organization's reference. Talking to other, CEOs of other companies they purchased and what they did well and what they didn't do well, and you just, you got to have your eyes wide open. Got to do your diligence.
So from here on out, we can open it for a handful of questions here, and that anyone may have right now.
Are there specific industries that you work with, or industries you don't work with?
Well, we work in a lot of industries. I would say,
Maybe talk about the 3 verticals.
yeah, well, so most of what we do falls in the business services, mostly technology-oriented business services, specialty manufacturing or niche manufacturing, and healthcare. Now, those verticals we identified from what we've done. They weren't necessarily what we chose to do. And we've done very diverse things. We've sold construction companies, precious metal trading organizations. We, when you said what you don't work in, I was thinking of saying real estate, but we have and would work in real estate services, but we wouldn't sell real estate per se.
Project finance we would not do.
Yeah. I would have said at one time we won't work with commodities, but we sold a commodity trading company. Basically, for us, our little team, we look at it and decide if we can see an investment thesis and we can see an end game that's as good or better than what we think our client wants. And frankly, if we can work with the person. And we've met with people that we left the room and said, we aren't going to be able to work with this guy. And, we're paid at the end of this thing. So to us, we're going in getting a partner. And, we own our firm, so we don't get salaries and things like that from some big organization. So if we can't deliver, we don't have anything at the end of the time, and we don't have a referral and a referral from that referral or any of those things. So for us, and now you're really talking about our little world, we got to know that we have to have a high degree of confidence that we can get the deal done to our client's expectation. And if if the guy's going to be a roadblock or isn't going to be truthful with us, then we aren't going to get it done.
You have a question there in the corner?
I actually have a few, if I'll just fire
Sure.
them all out. Do you have a minimum size of a deal? And if not, do you have a minimum price? Are you always working for the seller and never the buyer? Generally, does the buyer have someone like you on the other side, so to speak, and you only work one side of this transaction?
Yeah, we only work one side. We're almost always the seller. Sometimes, we've sold companies to companies that have hired us to find other companies like that company.
Well, we have a buy side now.
But, we're not getting paid by both sides. We're working on one of those now. But we pretty much have to work on a deal that's worth at least $5 million to carry the kind of fee we want to charge.
Okay.
Most of what we do is in the $15 to $50 million enterprise value range. You know, frankly, sometimes we charge a lot more to do a $7 million deal, to make it worth, our while to do it. And if, if the client thinks it's worthwhile to them, then they engage us.
And then a third question is, if you have a letter of intent and it says you suspend all sales activities, which is contrary to what you just said, always have more than one party looking.
Oh, well,
What do you do with that?
well,
Deny it?
no, that's, it doesn't quite work that way. The letter of intent says that they have an exclusive period in which to get the deal done and that you're not going to contact other buyers, and that's fine. So we're dealing with sophisticated buyers here.
Right.
So they know when we tell them that we've entered into a letter of intent and an exclusive period with a buyer, they know what that means. That means that we can't go out and solicit new offers. That doesn't mean that we won't take the guy's call, the other buyer's call. He'll call and say, how's everything going? And we might say, fine. We might say, well, we might be calling you in a month.
Okay.
And it doesn't prohibit us from doing that. Lots of buyers try to put in their letter that any contact from another buyer will be turned over to us. We would never advise our client to do that because we want to have the ability to talk to them. But we aren't, we're very careful. We're not soliciting them. We're just...
Thank you.
Anyone else? Yes?
How do you see the space changing in the next 3 to 5 years? Do you see more syndicated deals going down or anything like that?
I don't know that I see that much. I guess the biggest change I would see is sooner or later interest rates have to go up. And that will affect at least financial buyers in terms of what they will pay. Right now, because interest rates are so low and funds are so plentiful, there's probably a turn or two of more debt available than there was, so that is reflected in prices from financial buyers. There's still, have been a lot, even though there were fewer funds raised last year than other years, there's still a lot of money out there. I guess a slowdown in the economy would change things. We certainly haven't been in any robust growth period, but, we've been sort of slow, steady growth. That's a good thing. If it went the other way, that would be a bad thing. I don't see any sort of systematic change. Do you?
No, the number of PE firms out there in the market, so looking at the financial buyer side of the spectrum, has continued to grow over the years. So there is a significant amount of capital that needs to be put to use from the financial side of things. But as large corporations have improved and built healthier balance sheets since the recession, they have the wherewithal to go out and make acquisitions. So I think one thing that may change is, are they going to continue to buy businesses to spur their growth at the same rate that they have over the last 2-3 years? Because we've seen on the deals we've worked on recently where strategic buyers, the large corporations, have been coming in with pretty impressive valuations and bids, and at times are outbidding financial buyers, which historically have been able to put the leverage on the business and maybe model out a valuation that's been higher historically. So we'll see if that continues in today's environment.
The large PE firms and all the money, that's driven them downstream though, right? So if you
Yep.
look out over the next handful of years, probably those buyers that are sitting on a lot of cash are moving down and looking at lower price deals, lower cash flow deals. Anyway.
So in your guys' personal experience, what is the worst merger acquisition you guys have ever dealt with in terms of overvaluation? So for example, if in a broad spectrum, there was an overvaluation of the AOL Time Warner merger back in 2000, the Pacific Gas and Enron acquisition in '96. Based on your personal experience, what would be the most overvalued transaction
You mean that we've done?
Yeah.
Well, I haven't thought of it that way. I've
They've all
seen
been success.
yeah, I've seen private equity firms not understand the investment thesis that they bought the deal under, and so execute like go left instead of right out of the box. And I think that was a lesson for all of us. And so you say, well, how do we ensure that doesn't happen? But the truth is, these guys did seem to understand it when we did the deal with them. So I'm not sure how I think what happens with a lot of, and this was a technology company, so I suppose that this is more likely to happen with a technology company and somebody tries to apply it in some way that's unproven and it doesn't work. But, I can't think of something that was just a dead bust.
Just on not a specific scenario, but often probably technology, because they're betting on the come and betting on an industry to unfold a certain way. But once you get off kind of a normalized valuation process and you get away from whatever 1 to 3 times revenue or 1 to 5 times revenue and get off of 5 times cash flows to 8 or 9 or 10 times cash flows, once you kind of get off of that and you start talking about X dollars per user and they're going to lose money out into perpetuity, once you start getting into some funky valuation metrics, if the industry changes or the wind shifts or whatever, then I think that's where you run into scenarios that don't work very well.
It's sort of the basic lower middle market company. And so we work, the market is kind of stratified to middle market and lower middle market. And we work in what's called the lower middle market. And when I started in this business, I thought of the lower middle market as under 50, and now it's probably characterized as under $250 million in value, enterprise value, because the stock market's increased and because the capitalization of public companies is so much higher. And lower middle market companies, which, if you put aside sort of big technology plays that are based on game-changing things or on, huge growth scenarios, they probably, I think of them selling this for like around 5 times cash flow. And then I think the key considerations for an investor are the market or industry environment in which they're operating. So if it's an industry that's publicly trading at 12 times cash flow and consolidating, then you might see values higher than 5 because they'll be reflected by the underlying market or industry. And I would say the next key thing would be quality of earnings. And I would say that in general, businesses that have EBITDA margins in the mid-teens and higher are considered higher quality of earnings companies, and they'll trade higher. And there's exceptions to all these things, but because there are things that have no earnings and trade at big numbers. And I would say, I would put revenue expectation up in the market and industry things. I said the third thing would be management.
So it seems to.
So having strong management or a full management team is more valuable than not having one.
It seems like there's a lot of strong value investing principles. Investing into a company with high financials, solid management, and realistic financial ratios. Correct?
Yeah, but financial ratios is a relative thing. They don't care about the capitalization of the company because they're going to recapitalize it. And but you know, if it's a business that's been around a long time or it's a traditional business model, then those ratios get more important because they reflect the kinds of returns to invested capital that the new owner might expect. But we sell lots of things that have, you know, low returns to invested capital because they're about proving that that there is a market for the technology or the product or the service, and that the gross margin is there. And so what the buyer's doing is buying it to ramp up what's already there, and then he would expect much higher returns.
I'm just going to step in and I know we're just running a hair after right now, and we can stay in this room as long as we want to if you have questions for Joel, Chip, or Rick. They're here to answer any questions you have, or if you want to sit and talk to some of our guests today. I want to say thank you guys for taking your time to come out, and it was wonderful. Thank you for coming up from the Twin Cities, and I appreciate it. Thank you.
Thank you. Thanks.